Morning. I have the opportunity to talk a little bit about my favorite subject, which is about risk. And one of the things that I'm a strong believer in is risk is used in a term that is very related to losing money or portfolios going down, but it's never in a constant state. It is always around, and I'm going to just touch on a few of the basic things and have a few comments about how it might apply to today's markets. And it's not a constant state. And straight out of the book, the two basic types of risk are systematic risk, which I don't think that you can diversify it away. These include things like economic recessions, political instability, interest rate changes, and I've got some more specific things to say about interest rate changes because we're in that mode as we speak. There's also unsystematic risk. These are specific risks that diversification can help. And what that means is if we have individual companies or industry-specific events, for example, labor strikes, scandals, lawsuits, bad earnings reports, product recalls, this is where the diversification can help that component of risk. The systematic risk, that has to be dealt with in a completely different way. Here's a picture of about a 10 or 12 year period in the markets, and it goes back to 2000 and 08. And those are the great bear markets that we've had to deal with. And I've seen the stats. There was more changes of advisors, more people giving up on recruiting after having endured a couple. Both of those were in the 50+% returns. And this is a picture, just a crude picture of the S&P going back. Here's a picture of the Treasury bond. Now, the Treasuries are part of the cornerstone of fixed income. It's backed by the U.S. government. And this little simple picture over the last couple of years or so, since probably 2020 when they started raising rates, is down 44% for something that is perceived as the safest and backed by our government. That's pretty traumatic. And for people to blindly invest in treasuries without risk consideration is probably not in your best interest all the time. And I'm going to conclude just a little bit here. I know that great advisors are always assessing the amount of risk in their portfolios. We get these questions. Look at our portfolio and tell me how much risk is involved. In today's portfolios, especially the ones of a 60-40 variety, 40% of your money is supposed to be in fixed income or things that are perceived as safe. In most cases, I think that as much as 80 or 90% of their portfolio is in a much more risk position than it might be perceived in terms of 60-40. The questions that we get that I think that are important is, if I was talking to an advisor, how do they structure and manage their portfolio volatility? If I'm considering a fund, an ETF, or an individual stock, I think that I need to have a specific answer, knowing full well that it's going to change over some period of time. That also allows me to do a better job for the people I'm managing assets for. I guess my self-preservation component comes out as the real good advisors who build on assets under management, which most of us do, know the impact of large losses in client portfolios. And what I mean by this is that if you are basically passive investors, there are times, we just went through a couple that both stocks and bonds had extremely downside corrective action. And as you write or send out your bills at the end of the month, you're going to bill on a lesser number. And I think that's worthy of me spending an inordinate amount of time concerning the portfolio risk that we have. There's several other kinds of risk. There's volatility risk. You have an earnings report, you have liquidity risk, you have market crises, you have interest rate risk, bond prices. This past couple of years, supposedly the safest place in the market has been the easiest area to lose money in. Housing market. Just saw a quick blurb this morning that at today's interest rate, which is 7-point-something% for a mortgage, they used an example of about a $450,000 house, that the interest over 30 years that you would pay for that house would be greater than the price that you put into it. So those are factors that I think that we have to deal with in terms of that. The bottom line is that the assessment of risk should be, from a portfolio standpoint, should always be important, because there's a lot of ways to lose money and it's very hard to make it. So we try to be on the right side of risk assessment.
Thank you so much for watching this video today. If you enjoyed this content, please consider subscribing to our YouTube channel, where we are regularly posting videos about various topics. Thank you.